Welcome back to Neil Invest, guys. Thanks for joining me here today. Today we're going to look at what are the top 5 dividend paying stocks within the UK. I'm looking to diversify myself a little bit more into the UK. I'm looking to diversify myself a little bit more in terms of the dividend stocks I hold. So we're going to run down the top 5 now. Let me know what you think. Thanks for joining me here today at Neil Invest. If you're new to the channel, what we look to do is track my portfolio over the next 13 years to see how that I can reach my financial independence. We also look over a number of companies. We look at analysis. We look at what's going on in the news, all sorts of stuff related to investments and stocks across the world. If this sounds like your sort of thing, please consider subscribing. Today we're going to look at the top 5 dividend stocks as I see them across the UK. This is an area I'm looking to diversify myself into more. Also at the end, if you stick around, there's going to be one additional company which isn't a dividend payer at the moment, but I see massive future for it. So let's get to it. This is my personal investment ISA portfolio that I have through Hargreaves Lansdown. And within here, for people that haven't joined us before, I have got 5 funds that pretty much cover the world. I've also, as you can see, I've got 3 individual stocks in Aviva, Shopify and Tesla, but I've got 5 funds that pretty much cover the whole world. One of those funds that I have, an index, is the HSBC FTSE 100 index, and over the course of the last 12 months this has performed worse than anything else that I've held, and it has returned 3.16%. So as you can see, versus the others that are doing a lot better comparatively, the next one up is Legal & General European Index, and up from there we've got S&P 500 and on and on and on. The way that the global markets work is that any given year you'll have one part of the world that outperforms another. So over the last couple of years it's been North America that's been top of the table. Before that it was global bonds. In 2017 it was global emerging markets. 2016 global emerging markets. 2015 Japan, and on backwards. And every fund, every part of the world performs differently given in any given year. In 2020, UK all companies performed at -6.2, so it was a pretty tough year for UK versus other parts of the world. 2020, North America performed at 16.2 in terms of a return. So in my view, this means that I think that the UK is currently undervalued. So that means that I am trying to identify what opportunities there may be. And with that in mind, I've had a look at some of the big companies that are held within the top 100, as in the FTSE 100, and identified my top 5 recommendations for the best dividend payers over the next 10 years. If that's your time horizon, the sort of time that you're looking to get a return on, this is going to be an appropriate video for you. If you're looking for returns inside 6 months, I'm afraid you're not going to find that here. So with that in mind, let's get to it, and let's start at number 5. In at number 5 then, we've got Reckitt Benckiser. So if you haven't heard of these guys, they own a load of brands that you will recognize. As you can see here, this is their website. A load of brands that are popular within the UK, and they haven't performed too well recently. Load of brands, these brands, therefore they're household brands. We know about these. They've got numbers, they've got a load beyond this, but this is just on their front page in terms of who this company is. They've got a number of sites throughout the UK, and they haven't necessarily had the most impactful 2020. So looking at their numbers, we can see got a market cap of 44 billion, currently trading at just under £62 per share. They've got a PE of 17, and when we look a little bit further down here, we can see their 5-year growth is just at 3.97%. So within the UK, it's been a relatively turbulent few years, I think it's fair to say. So 3.97% is a pretty poor return, as you can imagine, over the last 5 years. But this isn't about the past, this is about the future. At the moment versus 6 months ago, as you can see, they're down 17% so it is a pretty undervalued company in my view. At the moment it's coming in at 5th place. It's got a dividend yield of 2.82%, and if we look at the dividend history, we can see over the last 5 years that it's been growing it steadily. So the dividend is growing year on year over the last 5 years pretty steadily. They're increasing that, so that's a pretty good sign. 2.8 obviously is not a massive amount in terms of yield, but as that continues to grow, the yield on cost that you have on there, if you're holding that for a significant amount of time, is going to be pretty impactful. So then in at number 4 is GlaxoSmithKline, GSK. Who are GSK then? They're a massive multinational pharmaceutical company that are held within the UK. They're on the UK Stock Exchange, and they manufacture a load of products and brands that you will know really well. So they've got everything from prescription medicines, vaccines, to a number of different healthcare based products. Massive global pharma company, been on the FTSE 100 for a number of years. Let's have a look at the numbers then. Market cap £63.46 billion, Currently trading at £12.60 odd a share. We've got a PE ratio of 11, so a good PE ratio at the moment. And their growth over the last 5 years are down 6.18%. They're down over 3 years, they're down over 2 years, they're down over 1 year. So if you put money in them, put £1,000 in them 5 years ago, you'll have 6% less than that right now. Again, this is not about the past, this is about the future. So I see an opportunity here. I think this is a relatively undervalued company. Not only is it undervalued, but you're also getting a decent dividend yield of 6.34% at the moment, so very healthy dividend yield there. Worth bearing in mind, however, dividend has been pretty static over the last 5 years. Pretty static, I'd say, but exactly static. It hasn't moved an inch. So it's not been growing their dividend over the last few years, so we need to bear that in mind. In terms of the yield, that's been up and down, obviously based on the market cap. That's how that works, but they haven't been increasing their dividend historically. Who knows what the future holds? In at number 3, we have Unilever. Now, everyone knows Unilever brands, and actually most people nowadays know who Unilever are themselves. Ben & Jerry's, obviously, they're one of their products. They also own Comfort, Domestos, Lipton, Knorr, Hellmann's, Magnum, etc, etc. These are the sort of companies Unilever that they see a smaller company that's doing well in their sector, and they'll just buy them, acquire them, and it adds to their portfolio that they have. They become the behemoth that they are. 3 pages of brands there, and you'll probably know most of them. Let us have a look at the numbers then. Market cap at the moment, £102 billion. Currently trading at about £39 per share. PE ratio of 18.12, so within the area that you want it to be honest with you at the moment. Growth over the last 5 years, 34%, so doing a lot better than the other ones that we've looked at so far. But looking at the moment and where we are now is, in case you're watching this in the future, or we are in February 2021, they have dropped quite significantly over the last month. They've dropped 10% or so over the last month, so I see that as they're really pretty currently undervalued as they are at the moment. I think they're in a real buy territory for me at the moment. Dividend yield is around 3.8%, and they've got 10 years worth of dividend growth. So this obviously, it only goes back 5 years, but this as you can see, year on year over the last 5 years, they continued to grow the dividend, and they did do 5 years before that, so 10 years of dividend growth behind them, so they're in a pretty good place. In at number 2, we have got Diageo. They're predominantly an alcoholic company. They make alcohol brands. So I used to work in this sector myself for another brewery called Molson Coors, so close to my heart. These guys are most famous probably for Guinness, but they own Johnny Walker, a number of different whiskies and spirits. You see they've recently launched the Guinness 0.0% alcohol, partnered up with Beckham on the Hague Club Scottish whiskey. They again acquire brands left, right and centre as they see that they're appropriate. You probably recognise some of these ones at the bottom: Bailey's, Captain Morgan, etc. The thing I like most about Diageo is they are recession proof. So going through a recession, they probably see growth more than other companies, unfortunately, because people turn to the old drink. And let us have a look at the numbers then. So market cap of 70 billion, 71 billion nearly, £30 a share at the moment. PE ratio of 27, so you might think that's a little bit overvalued. Over the last 5 years, they've grown 67%, so you're not only getting the dividend over the last 5 years, but you've also been getting pretty good growth. And the dividend at the moment is currently 2.31%. They have also seen at Diageo a 10-year dividend growth, so really successful in terms of growing that dividend. If they were to keep that up, obviously you're going to get a much better yield, and you're going to really grow the cash that you're putting into the company. So I really like this company. In at number 2, Diageo. Right, into number 1 place then, and as you can see, we're back in my portfolio. So what does that mean? It means it's a company that I hold, and it is Aviva. I really do like Aviva. Who are Aviva then? They are an insurance company. They provide a number of different types of insurance across the UK. Big company, been around for years, will be around for years. Relatively safe bet. Obviously don't take that as financial advice, but they are across a number of different types of insurance: car insurance, home insurance, life insurance, whatever, etc. And again, let's have a look at the numbers. So market cap 13.73 billion, so the smallest company that we've seen so far. PE ratio of 5.46, which is the smallest PE ratio we've seen so far. However, the dividend yield is 7.73, which is the biggest we've seen so far, so they're a bit different from what we've been looking at already. Currently trading at about £3.50 per share. Looking at over the last 5 years performance, it is significantly down. It's 17% down versus 5 years ago. Improvement has been seen in the last 6 months, where we're 18% up, and as you can see within my holding, I'm 20% up, and I have just received a dividend of, it was about £12, which was the interim dividend that came in January. Looking quickly at their dividend history, they have grown that over the last 5 years, so they've got 5 years worth of dividend growth. A calculator, actually it's grown 3.7% over the last 5 years, so doing pretty well. It is a very high dividend at the moment. That does sort of pose some risks. Obviously, the higher the dividend, the riskier it is for a company to maintain it. They have given assurances in their recent comms that they will be continuing to pay that dividend, and that really is an indication of how far down they are in terms of the share price, which has dropped. But again, as I've mentioned a number of times, this is around a 10-year portfolio, and for me this is a really secure holding. I really like this company. I think they're going to grow. I think the dividend is strong, it pays very heavily, and I don't see too much risk in the near future of it. This company isn't going anywhere for a long time. I'm going to be adding some money to it in the future, and I'm going to continue to add to it. I've got the dividends being reinvested, so hopefully this will continue to snowball, and it's going to be a pretty big holding for me in the future. And finally, as I mentioned before, the company that I think has a good big future within a dividend portfolio but doesn't currently pay a dividend is Lloyds Bank. Within 2020, banking institutions were told that they were no longer able to pay their dividends, so this was a decision that was made on their behalf that was taken away from them. But I do believe once things settle down, they are going to start paying a dividend again. Lloyds Bank were obviously a historic company, very big company, market cap of 26 billion, so down versus where they were a long time ago. So they're trading at 37 pence per share at the moment. They have been as low as 28, 27p, something like that. Let's have a look. Here we go. 23 pence the year low. PE ratio 10.7 at the moment. Look at the performance over the last 5 years, 35% down. They've been beaten up pretty much left, right and center. But over the next 10 years, which is what we're talking about, I think that these guys are going to be returning, and I think that they're going to be returning their dividend. I think they're going to start growing it again. The fundamentals behind it, above and beyond what we can look at here, are pretty strong, so let's see what they look to do in the future. Thanks for joining me then today, guys. If this has been of use to yourselves, please consider subscribing so you don't miss out on any future content.